go through a few major points here through the process. Let's start here. One of the things I like to go through initially, just going through an investment strategy outlay, is something I really don't think gets talked enough even is like, what is a good investment? And how do you decide on an investment to start? I think before we even get into any of the economic stuff and strategy, just setting this as a pretty high level framework will be helpful, and I'll kind of revisit it a few times. So the first thing I always tell people is when you're going through with an investment, you're looking at ultimately the price you pay being a byproduct of ultimately future cash flows, right? So I think my wife and I were just finished watching Schitt's Creek, and so I was going to use the example of even Bob's Garage. So whether it's a local business opportunity or even something publicly traded as big as Apple, it doesn't make a difference. Ultimately, what you're looking at is the price that you're willing to pay is a byproduct of future cash flows, right? And so those can be cash flows year over year. And that is, when I say cash flows, so this isn't just the revenue that the business produces, it isn't just earnings that it produces, but it's the actual cash that can flow back to you as the owner, right? That's ultimately what you care about. The business is going out, it's selling products and goods or services, it has its expenses, and ultimately whatever earnings can then be transformed into cash back to the owner. That's ultimately what we care about, right? That's the whole point of putting our money to work, is generating some sort of return from that money to begin with. But it's important to recognize not all cash flows are created equal, right? What I mean by that is obviously investing in something like Bob's Garage, right, is going to be a lot riskier than investing in something like Apple, right? Bob's, even if it does have a long track record, doesn't necessarily have the same, infrastructure, operation prowess, obviously line items, maybe margins. There's all different things that are, particularly going to make Apple more attractive as an investment than Bob's Garage. So in order to figure out, well, what price we'd be willing to pay, we recognize there has to be some sort of discount, some sort of required return that we would have on those cash flows in order to make them equal, all else equal, I should say. And I'll explain what I mean by that. But this is just the starting framework of, hey, the price that I'm willing to pay means if I buy that business, I'm then going to get cash flows generated in the future that come back to me as an owner. And the nature of the riskiness involved in those cash flows needs to adjust my purchase price. Right? A more risky business, I'm obviously going to pay less for than a less risky business, which I'll pay more for. And I'll showcase actually how the math works on that. But this is just a really good starting framework to think about of anytime you're evaluating investment, again, whether that's a private business that's presented or a publicly traded opportunity of putting your money to work. Ultimately, this is how you're deploying cash. And in order to figure out, okay, well, if not all cash flows are created equal, what are we working with here? So ultimately, there is a spectrum that we're operating on. Okay, and that spectrum evaluates a risk profile with a return profile. Okay, and so on one end of the spectrum, we have what we would call the risk-free return, which are U.S. bonds backed by the full faith and credit of the red, white, and blue. Right, so you put in your money to a U.S. bond. It's arguably considered the most risk-free, riskless, I should say, investment you can make. You're giving your money to the government. They're going to pay you interest for that money, and you can feel extremely comfortable that you're going to get that money back when it's all said and done. And typically, that bond will have some sort of time associated with it. A common benchmark that we would pay attention to in the investment community is the 10-year U.S. Treasury bond. So, what am I giving? What am I getting in return for giving the government money for 10 years before I get it back? Right? What's the interest rate associated with that? And that's a good barometer for the remainder of the profile. On the other end of the extreme, right? Let's think about a startup company, and let's go even a step further. So not even just a startup company in the U.S., but let's think of an emerging market startup company, right? Because now you're introducing the risk of lack of financial infrastructure, maybe a lack of governance, rule and law. you've now brought in the risk of currency, right? Because now the currency might fluctuate amongst your investment. So that would be, even more risky than just investing in a US-based startup, right? Which might be somewhere over here, for example. And then just to kind of plant a flag, popular one that most people are familiar with or have heard of. Let's just say you have something like the S&P 500 that maybe sits here, and that represents the largest U.S. stocks that are available on the public markets that you can invest in publicly. And so ultimately, we have some sort of profile that's starting to get generated, right? Some sort of return that we would require in order to even make it worth our time of why we would be interested in one of these investments to begin with. Right, so clearly, if the U.S. bonds, which have historically offered, it wasn't that long ago, the 10-year was at around 3%, we would say, well, you need to obviously give me a whole heck of a lot more of a return than 3% in order for me to even be remotely interested in putting my money at risk in something like this, when I can put it right here at virtually no risk and get 3% return. And so we're starting to build out some sort of risk return spectrum that we can work off of. And historically speaking, you use this US bond, which is typically called the risk-free rate, as your benchmark, right? Because that's where everything starts. If I know I can put my money there to get some sort of return and have no risk associated with it, why else would I invest anywhere else? Right? Well, the reason is because typically they're going to offer you a premium. There's a higher return that you would demand as an investor in order to make it worth your time. So historically, there's some sort of premium. You could argue it's like 5 to 6% maybe for the S&P in order to make it worth your time, as an example. And so that's where you could see the S&P, where you'd quote anywhere from like 8 to 9% long-term returns. And the reason for that is stocks don't always go up. There's bumpiness, there's volatility, sometimes can feel like a roller coaster. So you don't have that certainty that you do have with the US government bond, for example. So ultimately, this becomes a very, very important starting point, because now we can work off this and it helps answer a lot of questions. One of the questions I've gotten from so many people is, how the hell are stocks doing so well when we have everything that we have going on right now? And this isn't the only reason, but something you can point to, right, is this return right now, this risk-free rate. I'm gonna stop sharing this for a moment and share. I was just pulling this up before our meeting. Is now where is this thing? Is now so as of today, or most recently, we have a risk-free rate of 0.79%. That's how low interest rates are right now. It's crazy. I've actually been having a lot of people refinance that I work with, because it's just nuts. I mean, think about 0.79. I was saying it wasn't too long ago that it was 3%. And why that becomes important, if we think about this spectrum, right? We've now dropped this risk-free rate below 1%. Well, if we're attributing a premium here to us, again, something like the S&P 500, now all of a sudden, instead of demanding 8 to 9% returns, I mean, you're literally talking in the 5 to 6% return space, where it would still be practical to deploy money at previously the same price. And I'll show you how that math works. But it's just such an important starting framework, because it kind of blows people's mind of like, how is this happening? And interest rates, again, it's not the only reason, but it is a big part of it, of why interest rates are so important. And I was talking to even my mother-in-law recently, and she was asking all about the election and like how important the president is. And I'll touch on this more at the end of the presentation. But really, I was like, the more important thing is probably Jerome Powell, who's the president of the Federal Reserve, because what happens with interest rates does have such a huge impact on asset prices. And again, this could be whether it's Bob's Garage locally and the value that you'd pay for that. Real estate, this works exactly the same thing for, and even the public companies. So all different spectrum here. And so what you ultimately then have is taking this information and transitioning it over to, okay, well, going back to the math on that, how do you then decide, well, what's worth paying? And so I'm going to share the Excel example that I had for us here. And so I just wrote this out here. So let's assume you have a company, Bob's Garage. Oops, I don't know if I shared that. Sorry. There we go. Let's assume you have a company, Bob's Garage, and so their cash flows are $200,000 per year. And in this case, you're going to say, well, even though they've been operating for a while, it's a small business. There's a lot of risk involved with purchasing a business like that. I'm going to assign something more aggressive than just 7 to 8% that I would from the public markets. I'm going to go with 15% on that type of investment. So that tells you just straight up, you would not be looking to pay anything more than, call it $1.3 million for Bob's Garage. Whereas if you have that same type of investment, obviously the cash flows would typically be larger, but let's say it's a publicly traded company, and just to make the example the same, you have $200,000 worth of cash flows, but it's a much less risky company. You can see that you'd be willing to pay a lot more for that company. Right, so as we lower that required return, we're willing to pay up for those cash flows. So that same dollar of cash flow becomes that much more valuable because there's a lot less risk inherent with it. And so again, that translates even to something like the return dropping. So let's now update it for the profile I was just talking about. So maybe it's only 5%. We can see it'll go from 2 million like all the way up to 4. So you can see how that becomes so important from a change of the purchase price that we're willing to make on that type of investment. All right, so we take this framework and ultimately we say, okay, Bob's Garage, operating 10 years, maybe let's just say they're doing $1.5 million in revenue, pretty consistently kicking off $200,000 of cash flow. We know more or less, it's a local auto shop. Addressable market, it's already well entrenched. They have a steady base of customers that are recurring, and we kind of know that business is there. Pretty easy to model out those cash flows, right? We could pretty easily do that and back into some sort of purchase price that wouldn't be so difficult, frankly. When you start looking at a company like Apple, as an example, right? Think of how much more challenging that becomes to model out those cash flows in the future years. You have new products, updates to old products, whether that's the iPhone, iPad, iMac, AirPods, iWatch, whatever they're doing, new entry to new geographies, so a new customer mix, all different types of things that can be happening that could change those future cash flows. So it becomes a lot more difficult to model those out. And I point that out because that's one of the reasons that you could have 40 analysts who are all brilliant from all the top banks following a company like Apple and all having a different target price on Apple, and ultimately also all regularly being wrong on that target price, because those things are changing so fast all the time. And that's not just Apple. I mean, that's Nike, that's Disney, that's JP Morgan, all these companies, when they have big companies that are diverse and have different revenue streams and product mixes and all these things, it becomes very difficult to model that out, just the way it is. And so getting to this price could be very hard to do ultimately. I mean, it's not going to be as simple as going and modeling out maybe a local store that's just doing under 5 million in revenue. So you can see how that then becomes really challenging in trying to pick, for example, what are the top 10 best stocks to own? Well, you're basically trying to forecast a future that's very difficult. It's inherently difficult to do. And so a lot of people will now basically throw in the towel and say, hey, I don't want to play that game. I'm not going to try and waste my time picking between the top 10 most valuable stocks. Instead, what I'd rather do is say, hey, let me just own a basket of these types of investments so I can own all 500 of those companies as opposed to just the top, trying to pick the top 10. And I'll recognize, hey, maybe the top 20 are going to do really well. The bottom, 40 are probably going to do terrible. But all in all, they're going to average out somewhere in between. And so that's where you have things like mutual funds and exchange traded funds. We're adding a sleeve into this, into your portfolio, and basically saying, hey, I don't even want to play the game of trying to pick individual stocks and picking these price points and all that because it's inherently difficult. I'd rather just pick these different entry points to build a portfolio. And this is the start of portfolio management and portfolio construction. So it's also something where this can be kind of a flag, and I roll my eyes when you'll ask people in the media will say, oh, hey, just throw your money in the S&P 500. Well, yeah, but then think about all the things that you're missing out on, right? You then have potentially, mid cap stocks here, maybe small cap stocks here, maybe international stocks here, right? There's all of these different assets that then you're missing out on. And typically when you're building a portfolio, you're combining these different things that are ultimately building out that appropriate risk return profile. And so that becomes so important because the media will oftentimes, again, using the S&P 500 as just an example, it'll use that as the baseline. But in reality, the risk return profile should match the objectives you have. Like, for example, if you want to buy a house, if you want to put your kids through college, if you want to take care of your parents, there's a certain amount of money that you can pretty easily figure out you need in order to meet those objectives. And based on your savings and income that you have, it's fairly easy to model out, hey, what type of return do you need in order to hit that bucket of money that you can then use to meet those objectives? And what return ends up being the profile that you need to figure out. And some people might say, hey, I'm not comfortable with that profile. In that case, okay, we need to look at your savings and income projections instead. Maybe there's some tweaks we can make there. And some people might be okay with the profile. And in that case, it's figuring out what is that right mix in order to achieve that. And so you can see it ultimately throws out the window this idea of like this arbitrary benchmark that is totally meaningless and useless in actually hitting the goals, and introduces this new benchmark of, hey, how much money are you actually looking to have, given the different objectives that you have? What's the return that we need in order for that to get there? And ultimately, given all of the different investments that are available, how do we want to structure the portfolio to meet those objectives? And so commonly what you'll then end up having is a portfolio of investments, not just a single pile of cash that you'd throw into one of these. And I'll just kind of like make something up here, but you'd arbitrarily draw it out. And so let's just say you have, for example, large US companies, medium-sized, maybe some international companies, and then maybe some bonds. And I'm just totally making this up depending on whatever it is. And so you might say, hey, my risk on target, so if you think of these being your three riskier investments, which would then have that higher risk return profile, is maybe 70%. So 70% risk on, 30% risk off. And that's just a target. So with like clients I work with, I might go as high, maybe their target's 70, but we're willing to go up to 80-20, depending on the market environment. Or maybe we're willing to go down 60-40, a little more common right now with their target profile. But basically you're setting some sort of profile where the mix of this is getting you the return that you would expect and need, given the objectives that you have, with the amount of, call it bumpiness along the road that would be expected. So you've now taken, how do I invest in an individual position, right, to saying, hey, not super comfortable doing that. Instead, I'd rather invest in a basket. And now how do I put that basket together to form the appropriate asset allocation mix that's going to match the return profile that I'm looking to achieve? And so you can go through that sequence. And again, ultimately, you see how interest rates and everything that's going on in the market can ultimately impact that based on what we were talking about. But that's the general framework of portfolio construction, what you would want to do. So then the question becomes, okay, knowing that, well, what do I do now moving forward, right? If I've gone through this process, I've identified the mix that I want, and obvious plug, if you don't want to go through that process and need someone to help you, you can reach out and I'll give